All right. So what the asset ceiling is about is because of prudence concept and to check people from not creating asset that does not exist. You know, normally the obligation should exceed the planned asset normally. All right, that is the normal thing. So there should be always a deficit. However, in some defined benefit pension plans, it may show a surplus. Okay. So like I told you that if the PV of the obligation exceeds the fair value of the plan asset, then you have a deficit. But if it is the other way around, then you will have a surplus, which normally does not occur. But if it occurs, there is a check that you need to do. And the check is that, this is it, if the defined benefit plan is surplus, IAS 19 states that the surplus must be measured at the lower of the amount calculated as normal. What do we mean the amount calculated as normal? This is what we mean. The amount calculated as normal is what you already know. So it is the PV of the obligation. So let's say the PV of the obligation, for example, is let's say 2,000. Then you do the fair value of what? The planned assets. When you do that, let's say in this case, the fair value of the planned asset is, let's say, 3,000. Meaning that over here, you have a surplus of how much? 1,000. So this is the one that I've stated that the amount calculated as normal. This is the one, surplus. That is the one. All right. So the lower of this and the total of the present value of economic benefits available in the form of a refund from the plan or a reduction in the future contribution plan. So you look for the what we call the PV of refund. What do we mean by that? I'm going to give you a practical example. You see this domestic debt exchange thing that happened. Somebody will have, let's say, let's use, for example, UGBS mutual fund. So the employer is doing a defined benefit and he has done a mutual fund. And this mutual fund, instead of the example I did with real estate, let's say he invested in government bonds. Okay. Now, if he invested in the government bonds, then it means that you'll be generating returns from the government bond. And that will be your ROA, return on assets. So that is that. However, we all know that there was this domestic debt exchange program. So what the standard is saying is that how much of the money you hold in the assets do you have control over? Do you remember the definition of an asset? Economic resource controlled by an entity because of what? Past events. And the standard, the conceptual framework, this is how it defines the asset. It ends here. But it says that the fact that you can control it means that there is a probable inflow of what? Economic benefits.
Sir, please, I'm not seeing the screen.
Oh, really?
Yes.
Are you guys seeing my screen?
Yes, sir.
Yes, sir.
Okay, then, Oga, it is a problem at your end.
Wow. So should I go off and come?
Yeah, I think that one will help you. So, a probable inflow of economic benefit. This is the definition of asset. So please, those of you who don't know, go and learn the conceptual framework. I'll help you. I'll put a video on that on your page because some of you had exemptions. You did not actually go through the basics. Now, what we mean is that if you have an asset, you should be able to control it. And if you control it, it means you have access to the inflow of economic benefit. So when you hold the asset in the government bond, now the government cannot pay you your money. It means that you don't have control of what is in the government coffers. So if you state in your books that you have a so and so plan asset, increasing the values of your asset, you are deceiving us. Because that asset you saying you don't have control. The government of Ghana, the money you put there, they chop them. So they are not releasing it for you to be able to get the benefit out for that asset back. But if you put in your books that you have that asset, and that asset you don't have control over it, then you are deceiving us. And you are killing the fundamental principles of faithful representation, which is the qualitative characteristics of financial statement. So that is what we are talking about. And so we are saying that if there is a surplus as such, which under normal circumstance, you see, this is the surplus you will be this is what you are going to post in your SOFP, net assets, net plan asset, because I told you that offsetting is allowed. So when you offset it, there will be no liability. What is going into your SOFP will be this 1,000. But the standard is saying that we can't allow you to record this 1,000 when you cannot even have access to that 1,000. We can only allow you to record the part that you can have control over, or you can have access in the form of what? A refund from the plan, or a reduction in your future contribution. All right. So that is what we are talking about. So let's say you hold this, you say you hold this, but what the government is actually giving you, see, government can do anything. It's actually giving you, is saying 700. We cannot allow you to post this 1,000 in your books. So we said the lower of this one you've calculated at normal, and what you can get in the form of refund, which is this one you are capable of collecting, of which you have control over. And so therefore, instead of recording this, you are meant to actually record the 700. That is what the asset ceiling is about. So this is what it means. This is what is known as applying asset ceiling. It means that the surplus can only be recognized to the extent that it will be recoverable in the form of a refund or a reduced contribution in future. In other words, it ensures that surplus recognized in the financial statement meets the definition of an asset, a resource controlled by an entity that will lead to a probable inflow of economic benefit. So you will need the amount calculated as normal. So we will do some example, you see, and the present value of the benefit available in the form of a refund or a reduction in the future contribution plan. That is what an asset ceiling is about. Please, is that okay now?
Yes, sir. Thank you.
All right. Thank you very much. Now that everything is clear, let's do our quiz. Let's do our quiz. So question 1. And now you have to answer. You have to answer. Please, this is the question. This is the question. It says that Della has a defined contribution pension scheme. It has a defined contribution pension scheme. However, during the year, it introduced a new post-employment plan called the fund for its employees as a way of enhancing the benefit they will receive when they retire. Della makes a monthly contribution into the fund that are equal to a set percentage of the salary cost. Upon retirement, employees will receive, Mr. Lawe, you are writing on my board. Please. Why will you do that? Upon retirement, employees will receive annual payments from the fund based on their number of years of service and their final salary. The fund is voluntary, and Della can cancel it at any point in time. And it says that Della has a has a history of employees' benefits that are substantially above the national average, with annual increases in excess of inflation. Della has won many accolades as a top employer and received positive coverage from the national press when the fund was announced. The leadership team are well trusted by the employees. Advise Della on whether the fund is a defined benefit plan or a defined contribution plan. Ladies and gentlemen, who is answering the question? Which type of plan post-employment benefit is that? And if you tell me, you have to explain why it is a particular one. Yes, yes. Please, let's be fast with it. This thing is a recorded class. And so you wouldn't want to be listening to your own recording and there was silence. Yes, a volunteer.
I think it's defined benefits.
Please, who is speaking? Patience.
Hey, so this thing. Yes, I'm thinking it's defined benefits.
Yeah.
Because
Thank you. The because is what I need.
Because it said upon, it said it's when they retire. Okay, so the contribution into the fund that are equal to as a percentage of salary cost. It means that they made a contribution to a fund, and it's also saying that there is upon retirement, employee will receive annual payment from the fund based on their number of years of service and their final salary. Based on that, I think is defined benefit.
But even that one, that's what Senate people do now. It's based on your year of contribution and service.
Hello, sir.
Yes, Mr. Ransford.
Sir, like just to add on to what Patience said, I think that this one, the introductory aspect of the question made it clear that the fund is set up by Della himself as a company.
Okay.
And per the principle of defined benefit plan, the employer sets up a fund and tries to manage the fund to earn return on assets. So based on that, we can easily say it is a defined benefit plan.
That one is very, very clear. So you use the explanation we did on the defined benefit plan and relate it to the question. You understand? That is how you solve the question. What it is as said by the standard and what this question is also saying. So you realize that we said that in the defined benefit plan, yes, it's the employer who controls the fund, and therefore there should be enough money in the fund so that when the employee retires, the employer can be able to take care of it. And there are so many sentences or statements in this question that makes you so clear that the employer is the one who will have the obligation when the employee retires. A typical example is that they said that Della has a history of paying employee benefits that are substantially above the national average. So he's the one that will take care. So he has the liability. But you see, it is true because they will also invest the money and get return on assets. So those are the things. But as for where you say the employee contributes the money, whether it is a defined benefit plan or defined contribution plan, the employee will contribute. And it is not just about the service, because whether it is a defined contribution or a defined benefit, that one too, if you pay it to a third party, like the way I explained it yesterday, that you pay to Senate, that one is a defined contribution, is a third party. Senate will only look after you when you serve the required number of years, which is like 15 years. Yes, so that is how it is. So per what your understanding from yesterday, that is what Mr. Ransford has spelled out clearly. So this one is a defined what? Benefits plan. Please,
Sir, please, can I ask a question?
Yes, please.
Okay, sir. let me please find out with the defined benefit plan,
Mhm,
can a private institution
mhm.
opt for that option and decide not to pay in contributions to the defined contribution?
Are you talking about practically what happens in our Ghanaian society?
Yes, practically in our Ghanaian society. So
No.
I'm a private institution and I
No.
can opt for
So you won't pay it to Senate, you create your
own fund and pay my employees contribution.
no, you will have to what is that act? I've forgotten. You have to go and there is a whole industry for mutual fund though. There's a whole industry for trust funds.
That's fine. Yeah.
Yes, it's a trust fund. There is a whole law on that one. So if you want to establish one, then that is. But if not that, every company is obliged to, especially the private sector, they don't even have a choice. You are obliged to pay the 30% to Senate. It is compulsory according to the Senate Act. And even in our, I think it is also enshrined in our tax law. I think it's section 91. Wow, the people want to do lies out of section 91. Yeah, I think it's also there like that. So you can't, a private person, you can't. Unless you go through the due process to have your own mutual.
Okay,
As far as I know, it is the universities that have been doing it themselves. KNUST Legon is the only one I know. All right, please, let's move on. All right, so question 2 says, an entity makes contribution to a pension fund of employees at a rate of 5% on the gross. For convenience purposes, the entity pays 10,000 per month. Yes, please.
The one. Please, can you give us the point? Do not explain them, but just the point.
Oh, the solution. I've added the solution and I've added the point.
Oh, okay. It's okay. Thank you. Then let's go.
It's just that so that we can be fast. But I don't want you guys to be going to look at those ones, please. We discuss it, you go back and reference it in the solution. All right. Now, an entity makes contribution to the pension fund of employees at a rate of 5% of gross salary. For convenience, the entity pays 10,000 per month into the pension scheme, with any balance being paid in the first month of the following year. The wages and salary for 2016 is 2.7 million. You are required to calculate the pension expenses and the accrual/prepayment at the end of the year. Yes, any volunteer in the first place, I wanted to ask if this one is a defined benefit or defined contribution. But regardless of that, who is willing to give me the figures? How we go around the figures?
Hey, how many are you doing?
Hello, sir.
Yes, please.
The entity makes 5% of gross salaries.
Mm-hmm.
5% of total wages and salary, that's 2.7. You 5% on the 2.7.
Please, how much is that? Everybody calculate that. Let's move.
Kwame, where's my calculator?
It's here.
Give it to me. All right, carry on.
Yes.
0.135.
All right. 0.135 million.
Yeah.
All right. What? Yes.
0.135 million. Then we multiply for convenience. The entity pays 10,000 per month into the pensions fund. Then we multiply 10,000 by 12.
Let's rewrite this one in the proper figures. Okay. so that the 10,000 to shoot well. So multiply that thing by 1 million.
Okay.
So I think we should be getting 135,000. Yes, go ahead. You said 10,000 by what?
10,000 by 12 months.
By 12 months.
Yes, please.
That one is 120.
120.
Okay,
Then we find the difference of the two.
That
will be 15,000.
Okay. This is mathematics we've done. What is the accounting meaning?
Which means that they have underpaid.
Okay.
They have underpaid the fund.
Okay.
They have underpaid the fund. Yes.
So how do you treat this one? Yeah, 2016. How do you treat it? What is the accounting entry?
It's a liability.
Yeah, so what do you do? Debit what, credit what?
If you are underpaid, then it means you have to debit the 15,000.
To where? Where?
We are debiting that one to the P&L.
Okay. What line in the P&L? Staff cost, right?
Yes, sir. Staff costs.
Then credit what?
And credit salary is wages, staff wages payable.
So this one is an accrual, right? You have enjoyed it, but you have not paid. So that is the accrual, the question, and accrual or prepayment. So this one is an accrual, right? Of what? 15,000. So that when you enter, the question said that any balance is being paid in the first month of the following year. So you create this liability there. So in the first month of the following year, you go and pay it off. Please, is that okay? Please, is that okay?
Sir,
yes, please.
Sir, in fact, I am happy the way you were able to come out with. But can we get the chemistry behind what we are doing?
I don't understand your question.
Yes, like when you pick the question, what is the question asking us to do?
This is calculate the pension expense for 2016.
So please, do you have a formula for that? Or there's no formula, we are just going through just like that?
Hey, this is accounting, there's no formula.
I know, but probably maybe you need to write some data. You pick A, you pick B. Since you don't get A, then it means B, you can apply B.
No. You don't do that. You understand the concept, then you apply the concept. If you don't understand, if I give you step 1, step 2, step 3, when you go to the exams and they miss you with one thing, then hey, no, when you understand it, those people contributing to this, it is out of understanding. See, that is why I take my time. You won't actually get this thing anywhere, sincerely speaking. That is why I take my time to explain the standard before we apply them. So it is good that you understand what we are doing. The understanding is the most important thing, because you are not going to be meeting similar statements. But you see, with what he said that, see, the company makes contribution of a pension for 5% of the gross salary. This is 5%. Where is the gross salary? Wages and salary gross. This is it, 2.7. Okay, so we've done our 5% of the 2.7. This is what we have. That means that is the contribution that they are supposed to be making. But the question said that because of convenience, the company pays 10,000 per annum. This is what they are supposed to pay. And they pay 10,000 per month, giving them 120,000. Meaning that the company hasn't finished paying this 35,000, but this 135,000 is supposed to be what should be in their P&L. So even this thing that you are doing for me, I just wanted to find out how you people deal with it as in per your understanding. But the question said calculate the pension expense for 2016. So the expense, this is the expense. This is the expense. So your debit is 135,000 in P&L for the expense. Then your credit is how much? They've paid cash of what? You credit cash or bank of 120,000.
Yes.
Meaning that there is an accrual or a payable to be done, which is what? The 15,000. Then your journal balances. So that is it. There is nothing like a formula. No. You do it out of understanding. Yes, please, any question. So it is your understanding of the question, but please let me advise. If you speak P and you are reading the question in English, just convert it to P. If you speak Hausa and it's not going well in English, convert it to Hausa. Okay, it helps a lot. I practiced that when I was a student. And even now I'm still a student. I really practice that thing. I convert it to my language that will make me understand. Okay.
Hello, sir.
Yes, please.
That's why we are urging that a local language should be used in the public schools or in the
this is social studies class you want to do here. Don't worry. This is an international class. There are people speaking Hausa, there are people speaking P, there are people speaking, so I can't use one common language.
That's by the way.
All right. So please, but any question? So who asked the question about the formula? I think it also. Mr. Ben, was it you?
No, please.
Yeah, so please, I've forgotten the person, but there is no formula. There is actually no formula. It's the understanding what we've done, and see, this one makes you know that it's a clear, defined contribution plan. Is that not it? And if it is a defined contribution plan, we actually stated where you debit and where you credit. So please, I beg you, I indulge you to understand what we are doing. Please, if you didn't understand, as at yesterday, you have a second bite. It is on YouTube. It is on your Telegram. Kindly go over. It will help. It will help you. Question 3. Question 3. So this question, what I'm going to do is that I'm going to pause the recording and I'm going to allow everybody to do it. Please, in exams, such questions like this should take you 6 minutes. So we are practicing. And this is what you understand what we did yesterday. So please, I'm giving you, it is 1919 GMT by 1925. You stop work. So please start now, everyone. Start now. So brought down. Which figures did you use for the brought down?
I used 200.
This one?
For liability. Yes, please.
Oh, why will you do that? This is carried down. These are December figures. These are closing figures.
Yes.
So why will you use that as the opening figures?
Okay, so this becomes, the 200 becomes my opening figure for 2015. And then the brought down is 120.
But I want 2014.
Sir.
2040 is 140 over 80. Or minus 80, which gives me 60. And then the 2015 is 80 as my net obligation.
But see, you really understand it. But if you pick wrong figures, the examiners are not merciful. So please be careful. Pay attention.
Okay.
All right. Then yes, 2015. 2015, please, guys. Let's get on board.
2015, 200 and 120.
And give me the figure.
That's 80.
Okay, yes. What else? What next?
And then the service costs, which is 30.
If you check what I gave you yesterday, something comes before the service cost. Even though you can decide to rearrange it the way you want to, but I feel like just so you don't forget, immediately after this one, there is something that comes. You need to.
Okay.
Yes, who else? Please, let's all get on board and do it. We are working with time, please.
Sir.
Yes, please.
This is what I did. 2014, the net obligation, I knocked off the 80 from the 140. I had 60.
And that is here. It's here.
Yes. Then I had the net interest. I'll calculate the 4% on the 60.
Okay.
I had 2.4. Then the service cost is given 30. Contribution to the plan 25. That one is going out. It's an asset.
Yes, I'm at 2.4.
The interest, the net interest is 2.4.
Okay, 2.4. Of course, if you do the percentage on this one, you are using the net figures.
Exactly.
Or so you can also decide to do it on this one and do it on this one. Then you net it, whichever way you want it. But please, one thing I should draw your attention to is that the interest here, they are calculated on the opening figures, because you don't go to bank investing money on 31st December and expect an interest in that same year. It doesn't happen anywhere. These are the things I say, do the thing with understanding. Don't just do, oh yeah, when we do this, we do this. No. You can't pick the closing figure and calculate an interest on that. It doesn't happen anywhere. Where will you go and deposit money the last day and say you want the interest for the year? So you know that this is the beginning figures. The interest is computed on the opening figures. This is very important. Understand it. All right, let's move on. Yes. Then what else? Yes. Please, after the net interest, what else? My people are angry. They say they won't talk again.
The service cost component, sir.
All right.
And that is 30.
30. Where are you? Service cost. Past and service cost. Okay, here is 30. All right. Yes, what else?
Contributions to the plan. That is going out of our fund. So it will be credit. Thank you, sir. Then we write the remeasurement.
What about the benefit? The benefit fee?
Knockout.
To knock out, but you have to show it.
Okay.
All right, then you said the remeasurement.
Yeah, we have to institute that one before we go to the net obligation carry down.
And so how do you do that?
This is a balancing figure. So let's find the closing first.
All right. So who is the one talking, please?
It's me, Danny. Net obligation carry down.
All right.
At 31st December.
Net obligation slash assets.
Asset.
I put
carry
the assets into bracket.
Thank you.
This one is how much?
That's why we are knocking 120 from 200. So that will give me 80.
Okay.
So you sum up the top one and then find the difference. That will give you the remeasurement.
I thought you've done that already.
Oh, yeah, sure.
So give it to us.
I have 12.6 million
12.6.
for 24. I'm working
Negative
for
or is positive?
This one is positive.
All right. What about this side?
In fact, I was not able to complete that one.
Hi, time. This thing for 5 marks.
Who
Who did it? Please give us the
5.6.
figures. You said what?
90. That one is 90.
90.
Yes.
So here is how much?
There is 5.6.
5.6. All right.
Yes. It's also positive.
All right. So once you're able to do this, you already know that your measurement will go to OCI. So it says that determine the net plan obligation or asset at the end of 2015 and 2014 and 2015, and the amount to be taken to the profit and loss and the OCI. So first of all, is it a net obligation or a net asset? So SOFP in 2014, how much is going there? Is it a net obligation or a net asset? Oh, guys. Hello.
There is a net obligation.
But what keeps you people so long? I don't understand. Is it fear or what? And how much is the net obligation? The
80.
one is how much?
80, 200 minus 120.
And here is how much?
90 please, 230 minus 140.
All right, then what goes to our P&L? What goes to our P&L?
So the remeasurement loss.
No.
The net interest.
The net interest.
I thought I gave you guys all these things in a format before. All right. Net interest. How much is the net interest?
2.4.
2.4.
2.4.
And 2.4.
Is that the only thing that goes to the P&L?
No, the current service cost also.
Okay, the current and past service cost. The current cost, service cost is how much? Here is 30.
30.
32.
32.
So you can decide to add them, okay?
Okay, sir.
You should add, but for space purposes.
That would give us 32.4.
What about what will go to the OCI?
OCI is remeasurement loss.
Was it a loss or a gain?
So it's a gain because it's a positive figure.
All right. So 12.6 and what?
5.6.
5.6. So you can call this one P&L and other comprehensive income and add all the three together. Okay.
Thank you, sir.
All right. But is it difficult? So if you're able to do this working year-on-year movement, you just pick the figures and put under the various financial statements. Please, any question? That is the final answer. Any question? Any question?
Sir, please, the net interest.
What has it done, please?
I don't know where they had the 60 and then the 80.
Please, can you increase your volume? I can't hear you.
I thought of the net interest.
The
4% of the 60.
You said you don't know how they had the 60.
Yes, please.
Wow. Who else? Please, is there anybody else? Okay, so I'm going to call on Elikem. Elikem. Elikem is angry. Says she won't talk. No problem. Lily Forsen.
Hello, sir.
Yes,
Good
please,
evening.
how did we get the 60 and the 80?
It's okay, I've gotten it.
It's 140 minus 80.
So 140 minus 80. Please, have you seen Boo? Opening net?
Yes, sir. Later on, I've
That's-
gotten it, yeah.
You've gotten it. All right. So yeah, please, any other question?
Yes, sir.
Yes, any other question?
Okay. Hello, sir.
Please, whoever is speaking should speak aloud. I can't hear anything.
Please, how did you get the net obligation?
Which of the net obligations?
Asset.
Hello?
The
There is
carry
one
down.
here, there is one here. So which of them are you talking about?
The carry down.
The same, did you see
The
how,
carry down.
you have an
Not
idea
the
how we
FCA.
found the opening one?
Yes, please.
The same idea you take to do this. So these are opening figures, January. 140 minus 1, the same thing that you see here, closing figures, the same thing. PV of obligation, fair value of planned assets. So can you now see where we got it from?
Yes, please.
Are you sure?
Yes.
So tell me how we got it.
Okay, so as you said, so the opening minus the closing.
What
So
is the
the
opening? What is
opening
the
we
closing?
had.
Please, can anybody help her?
It's 200 minus 120. Another one is 230 minus 140.
Yes, please. Did you join the lecture yesterday? Hello?
Yes,
Did you join the lecture yesterday?
yes, please. But it wasn't.
Please, the video is on your platform. Kindly go and watch it there. It's on the
Yes,
Telegram
fully.
and on the YouTube platform that I showed you. So just go back and have a revision on it. All right. Please, let's move on to question 4.
Yes, please.
And please,
Yes,
let me say, move on now.
Yes.
All right. Now look at this question, question 4. It says that an entity operates a pension plan that provides a pension of 2% of the final salary of each year of service. On January 1, 2015, the entity improves from 2% to 2.5% of the salary each year, including service before this date, Employees must have worked in the entity for the last 5 years, or at least 5 years, in order to obtain this increased benefit. At the date of improvement, the present value of the additional benefit from the service was, so from January 2011 to January 2020, employees with more than 5 years of service, 150. Employees with less than 5 years of service, 120. The total is 270. This is the question. The question is saying, explain how the additional benefits are accounted for in the financial statement. What do you think this question is about? What is it about? So please, do you remember I explained to you the past and the current service cost? Do you remember?
Yes, please.
Yes, this is what it is about. So, and I explained to you that if there is an improvement, I even stated it emphatically, if there is an improvement in the pension plan, I remember saying that if you were employed in a company, there is an amount they pay, but they can promote you and decide to change the amount that they pay. I don't know if you remember those things.
Yes, please.
Remember.
Yeah. So these are the things.
500 and 700.
That is it. That nothing has changed. It's just rephrasing those things in the question form. Like this. So you don't put some fear in you. So what is the no. Like I said, if you think the English is a problem, convert it. So it moved from 2% to 5%, 2.5%. So that is what they've done. And the caveat is that you have to be there for at least 5 years. 5 years. Now, and this is it. This is where we are now. This is what we have. So the past, you see, the past service costs. Currently we are in 2015. That is where we are in this question. But they are saying that people will only enjoy the additional 0.5 for being there in the past to the present. So that one will be because of what? Past service. We are incurring an additional cost because some people have been there from the past. So that is what we call what? Past service. Currently is probably 2015. So they are saying that somebody must be there for at least what do you call it? For 5 years. Because you should be there for at least 5 years. And these people have been there, employees with more than 5 years already, as at this date. This is the new figure, the increment. And it says that employee with less than 5 years at this date. Averagely, the length of service right now is 2 years. This is what they are also, this is the increments that come about again. So please, this one is a straightforward. So you have two past services, whether it is past service or it is a current service cost, they are all what? Expenses. They are all expenses. That is what you need. Now, this is the caveat. It says that where is it? Employees must have worked past for the entity for at least what? 5 years in order to obtain this increment. So at the date of improvement, the present value of the additional benefit for service from 1st January 2011 to 1st January, this is like, how many years is that? This will be like the 5 years, right? Yes, it's what you see there. So employees with more than 5 years. So this one means they've crossed the 5 years already. And they said employee with less than 5 years. Then this one, and they said the average length of service was 2 years. So it means that as we are recording this transaction in 2015, we just bulk this figure up. And this is where we are, 270. And this 270 will be as a result of what. So you see, you clearly see that if this one was up to 5 years, they could have also gone to 150, but because they are of less than 5 years, this is the increment that they had. So this has brought about because of the past say that is happening in the entity. And so therefore, these two figures, which is the 270, must be treated as what? A past service cost. Straight away, you are done. You know how you treat past service costs. It is in the helping in determination of the remeasurement component. It's an expense. So an expense in the P&L. You know how to treat that one. So you just move ahead with it. So if you take time and you have made the explanations available to you, this is question 4. That is for a purpose that I did that because of the questions people will be asking. So if you come here, all the solutions of what you've been doing is here. Everything is here. But I just don't like that you go and watch it and give me answers. All right. So this is our question 4. So the entity recognizes all the 270,000 immediately as an increase in the defined benefit obligation following the amendment on 1st January 2015. This will form part of the service cost component. Whether or not the benefit has vested by the reporting date is not relevant to their recognition as an expense in it. So immediately, this 270, we recognize it immediately because it is an increment that has happened because of the condition that the people have been there in the past. So straight away, it's part of your service cost component. That one is a straightforward. All right. So please, that is that. Please, you have to go and solve this one. We have like less than 30 minutes. Yes, please.
When you were, sorry, so when you were talking about the past service cost, you did make mention of it helped in determining of, but you didn't end the statement.
Which one? Is it the remeasurement component? It helps you to determine the You see, when we're doing the remeasurement component determination, you see we added a service cost component, past and current. And do you remember the third one?
Yeah.
Gain or loss.
Gain or loss, exactly. So there will be questions that that one will pop up. Yeah, so it helps in the determination of your remeasurement component, which goes to the OCI. At the same time, it is a P&L item.
Okay.
I will not allow you people to solve this question on this platform now, because this question, you should be able to deal with it. But what we did even today, all right? So please practice and compare the answers. What I would want you to do is this question now. This is what we can close with. But you have additional questions there, like 14 questions, and the solutions have been provided. So please, you have no excuse. You have no excuse. When I asked you guys to solve the question, something just popped up on my WhatsApp, my phone, and I watch it. I like listening to this man a lot. He challenges me. Those of you who like listening to sermons, David Oyedepo. In fact, he made a statement. You said?
Winners Chapel International.
Yeah. I take time to buy his books, and he made some profound statements. I even put it on my WhatsApp status right now. He's making a challenge. He says the only classmates that you have is the people that you were in the class with when you were in school. Immediately when you finish school, they are no more your classmates. They are no more your classmates. Everybody is going to find his or her level. Yes. And it will take discipline for you to get higher level. See, the truth is that this ICA thing you are doing, it will take discipline, sincerely speaking. Sometimes, see, today, I'm so tired. When we started, I felt I was asking that, can we postpone this class? But you see, gradually, we started doing something and we are getting something. If I say, oh, we are laziness, then you postpone, that will be our downfall. That is that. Even the Abna, who was also tired, is still on track. That is how it works. So please, that is that. Now let's look at this question briefly. If we can finish and do another one, specifically some of the past questions. Let's see if we can do this and go and kill that one. It says that TC has a defined benefit pension plan and prepares financial statement.
Question number what?
Question number 6. Hey, why are you not looking at the screen? Or you are asking to go and look for the solution? So TC has defined if you do those things, I won't have solutions to questions again. TC has a defined benefit pension plan and prepares financial statement the first month each year. The following information is relevant for the year ended 31st March 2013. The net obligation at 31st March 2013 was 55 million. As at 31st March 2012, the net obligation was 48,000, comprising of a present value of obligation of plan obligation stated at 100 million, together with the plan stated at a fair value of what, 52. So that is the net. There's something interesting. The reason why they've given a breakdown, I can sense something interesting. It says that the discount relevant to the net obligation is what, 6.25, and the actual return on plan asset is 4 million. Oh, you are. I said it. The current service cost is 12 million. That one is straightforward. At 31st December 2013, TC granted additional benefit to those currently receiving benefits that are due to vest over the next 4 years, which have a present value of 4 million at that date. They were not allowed for the original actual assumptions. Well, oh, all right. During the year, TC made a pension contribution of 8 million into the scheme, and the scheme paid pension benefit in the year amounting to what? 3 million. All right. So please, let's now look at the question. Should I leave you to solve in the 5 minutes time before we come, or we should do it together now?
Let's do it together.
All right.
Let's do it together.
All right. So the question requirement is that explain the accounting treatment of TC pension scheme for the year ended 31st March. Okay, so 31st March, together with supporting calculation. All right, so let's do our workings. All right, so we are looking at 2030. Net obligation or assets. Brought down. Yes, how much is that? How much is that? Please, let's do it together. I'm not the one doing it. We said together.
It's 100 million.
The net obligation. Please take your time to read the question.
55.
It's 48.
It's not 55.
47.
Hey,
47.
it's not 47.
48. 48.
Hey, sorry.
So please pay attention to details. It's very important.
It's 10.
So it is 100 minus 52, as they've said. This is
Yes.
a net obligation as at 31st March 2012 opening. Go down. All right. Now there's something interesting in this question. So we say, what do we need? The net interest?
Yeah.
Yes, the net interest, how much is it? So they told us it's 6.25%. So 6.25%, we will calculate on 48. How much is that?
3,000.
It's what?
3,000, which is 3.
All right. I want somebody to do something for me. Please take the 6.25. You see, it is always net. Net means that you do the return on asset and you do the unwinding. So you get the net. They told us that it is 6.25 on the net obligation. That is what we have. But they later then said that the return on the plan asset is 4 million. 4 million. So what would be the return? What would be the one on the obligation? We already know the one on the asset. So what would be the one on the obligation? Obligation only. What would be on it? How much would that one be? Yes, who is helping? Please, do you understand why we call it net at all in the first place?
That's the difference.
The difference between
the interest on the unwinding interest cost, then the return on assets, the interest on return on assets.
Can you see that they've given you the return on the asset one to be 4 million?
Yeah.
So what is the one on the unwinding? Because see, we've done this. Be careful. Like I always say, do things with understanding. Somebody would think, oh, every day when you do the net obligation, then you do the net interest, you do it on this. That's how we've been doing it. No, I don't want those things. That's how we've been doing it. You know, I don't do that. So you see the explanation you gave me that it is net because you do the unwinding and you do the return on asset. Now they've given you the return on assets. What do you think the unwinding will be? So this is the balance.
You present value the life obligation.
Yes, but they've given you the percentage. This is the balance, the unwinding. This is the balance. That is why do you think they after giving you the 48, they now opened it up, telling you that the PV of the obligation part is 100 and that of the asset is 52. They could have just decided not to bring that so that when you are doing, you are free. But they intentionally brought that. They intentionally brought that. And so you have to be careful and always do the things with understanding. So let's say 6.25. If you do 6.25 percent, 6.25. Let's say if the percentage for both the discount factor is 6.25. If you do 6.25, oh God. If you do 6.25 on, so it means that if they say it's net, it means you can do 6.25% on this one and do 6.25 also on this one. And at the end of the day, you should get the net of 3. Is that not it? So what I'm saying is that when we say net, you explain to me, yes, 6.25% on 100 and 6.25% on 52, this one and this one. So this one is giving me the one on the balance. Unwinding is done on the balance. So I think 6.25% multiplied by 100 for the obligation.
6.25.
It's 6.25, right?
Yeah.
What about this one?
3.25.
3.25. Is that it?
Yes, sir.
The difference is what?
3.
Okay, so have you seen that? Here, but here they said that the interest here is 4. So what can you say about that? The return is 4.
It means the calculation has been dealt with already.
Which calculation, please?
The unwinding and its component has been dealt with already.
So it means what I'm trying to show you is that it means there is something you can't go your like that. It means there is something you need to watch out over here. So you see that the net. So if it had been 4 and you take off 4, how much would the difference be? 2.25.
Yeah.
2.25. The 2.25 and the 3. How much difference is that? Like 0.75, right?
Yes, sir.
Yes. So you need to give recognition to this 0.75 in your explanation, because the return on asset is 4, and we are using 3.25. So there is a difference between this 4 and this one, which is 0.75. You have to give recognition to that. Actually, I've actually explained it in the solution for you, but I want you to grasp the thing. Like I always say, is per understanding. So this one, of course, you can go ahead and treat this one, but when you are explaining it, so in terms of your P&L, you have to be careful. You have to be careful how much you will treat. After treating this 3 as the net, you have to now go back and tell them that, and also recognize this 0.75. So it means that the thing is 4, but only 3.25 is made reference in terms of this defined benefit plan. So the remaining 0.5 is an additional gain, return on asset, which when you are doing your P&L, you should take care of. But with regards to the movement, year-on-year movement, this is what is showing here, which later you have to show. Let me just help you and read, show you what I'm talking about over here. So this is what I'm saying. I know you have access to it. So this is what I'm saying. All right. So this is I typed this thing over here. Because I know students, and I have been doing this thing for a while, and I know that so for some of you, all you know is that when we do the net obligation, the net interest, we just multiply, we move. And I don't want you people to be doing that. That is why I've made, see, the net interest component is 3 million. Of course, you have it. Charged to the P&L. The current service, we will look at that one. But look at this. To the extent that there has been a return on assets in excess of the amount identified by application of the discount rate to the fair value, this part of the remeasurement component, which is this is the part of the remeasurement component, which I'm showing here as 0.5 over here. You need to explain that even though we are using 3 million, there is a part, and that part is a return on asset in excess of the amount that we are showing here, which is the 0.5. You need to give reference to that in such a way that when you are doing your P&L, for example, you need to show in your P&L that there is additional 0.75 on the return on the asset. So that is what I am trying to draw your attention to. So please, it is not straightforward. You're like that when you do this, you do this, you do this. First of all, you know what the net interest is about, so you can be able to prove it. That is what I really require that you do. That is what I require that you do. Like, you understand why we call it net interest. We are not just taking this thing and doing it on any figure like that. Please, that is my worry, and that is what I need you guys to be careful of. All right. Apart from that, I don't think there is anything in there that is that difficult. once you finish this one, like you've done, your service cost component will now come in. Let me even go back. Let me ask this one too. There was another 4 million. Instead of showing you the solutions, let's ask. See this one. Who can tell me what this one is? It says that at 31st March 2013, TC granted additional benefit to those currently receiving benefits that are due to vest over 4 years and which has a present value of 4 million at that date. They were not allowed for original actuarial assumption. What do you think this 4 million is for? Yes.
Present value that we have to calculate.
It's what?
The present value.
Oh, it's already a present value. They said which have a present value. It's already a present value, so you don't have to calculate any other present.
At the date.
It's a service cost component.
But which type of service cost component?
Current.
This is the current, so that one cannot be current. See, this is what I want you to do. Please read the thing and understand it. At 31st March 2013, TC granted additional benefit to those already receiving benefit that are over the next. You said what?
Pass.
Yes, it's a past service cost.
Because it's at the end of the year.
It's a past, yeah, exactly. It's a past service cost. This is the time they are giving the thing. Do you think if they are giving you anything in your current system, they will give it to you at the end of the year when you have already spent the year? How current would that be?
Okay.
So I beg you, guys, sorry, this one is 4. Then current is what? That one is straightforward, 12. Then what again? They made contribution. They said they made contribution. So this one will be 16, right? And the question said that during the year, TC pension made contribution to 8 million to the scheme. So contribution, right? That one is 8. Contribution. All right. Then the last one says that, and the pension paid, so benefit paid. How much is that, please? How much is the benefit paid, everybody?
3
How much?
million.
3 million.
3 million.
How much?
3 million.
Please, what did I said about the benefits paid when I was explaining each line one by one? What did I say about the benefits paid?
It's offsets itself.
Exactly. You see, what is the benefit paid? What is the benefit paid? Guys, be careful.
Sir.
Yes, please.
Can't you put that 3 million, put it in brackets?
Can't we do what?
Write the 3 million over there, put it in brackets, just like the way we wrote the 8.
No, that is not the explanation I gave you. So please don't even go there. Please, who can explain to us why the benefit paid is nil over there? Somebody actually said it, that it offsets itself, but probably when you said it offsets itself, so somebody doesn't understand what you mean by it offsets itself. So who can help me on that? We've done this, please. And then it means that you guys, you have to go back and watch the video and get the understanding and make notes and come and apply it again, because we have to move forward. So you have to go on. Now, what I said was that the benefits paid, you will take the benefit out of the plan asset, the cash from the plan asset, and you will pay it out to reduce your liability. So it's net of itself. So they brought you this figure just to confuse you. even if it is 10 billion, it will net off itself because you are taking it from one side and you are paying it at the other side. It's the same money, All right. It's the same money. You are taking it from the asset and you are paying it to reduce your liability. So it nets off. Into the always benefit paid is nil. Let's move on. I think that one will help. All right. But you are proving to me that whatever I explained to you, it looks as if you were not paying attention. All right.
I'll just give you the figure.
Okay, so what is the closing balance, the net obligation, the closing one? Yes, what is the closing one? What is the closing one?
$55.
55. All right, so what will be the remeasurement component, the balancing figure? So what is the question actually require us to do? We are supposed to we are supposed to explain the accounting treatment for this and back it up. So once we finish this, I think this one there, it's put up. Once you're able to do this working, you can just pick the figures and put it in the P&L and all. So this one will go to your SOF. What you are looking for will go to the OCI. Then the interest and the service cost components will go to where? The P&L. So this one will go to P&L. Then the net interest will go to P&L. But this one, be careful. That is where you make reference again back to the 0.75 the difference. Yes, it was also a return on asset. Okay, so that is where you make the reference to it and treat that. So technically, this thing will have to reduce to somewhere 2.25, since this one is a net interest obligation, and there is an additional 0.75. So please, that's all. So when you find this, I know you can go and peep the solution.
So it's 4, -4.
-4. All right. So that is that. All right, thank you. But before I let you go, you guys will go and solve the rest of the question. I think when you do it, when you take your time and you sit down, the understanding will come. Probably that is what you need. We did a thing at Saturday dawn. Most of you went for what do you call it? Weddings and funerals. And today, and most of you did Balaka the Salah. So you didn't actually open your books, I understand. So when the Balaka the Salah is over, come back. Come back and learn. All right, you see this question. So in November 2016, I'm not going to solve it. I'm just going to show you how the exams appears. You are giving this information, plan assets. So you check what is the requirement anytime you have a question. So it says that demonstrate how the above transaction will be treated as according to IAS 90, including the relevant extracts. So as at 2016. So it means that the closing is 2016. You come here, it's 5 marks. You come here,
I should be 10.
You realize that this will be your opening plan asset, and this one will be your opening liability. The net off is what you will start with. So you get it. Service cost for the year, 8,000. It is given. Discount is 10%. So you apply the discount on the net of these two, which I think is 4,000. So when you apply the discount, 10% be like 400. So 400, then you bring in your service cost, 8,000. See, this one, as tricky as it is, they've given you the remeasurement loss, but they didn't give you the closing figures. So, have you seen it?
Yes.
Yes. It's a very... Oh, this thing will not go. So you found this. So for example, the net of this was what? 4,000. You do 10% on 4,000, you get what? 400. Then you come service cost component. There is a service cost of 8,000 here. There is a past service cost of 6,000. Are you seeing it? Then there is a remeasurement.
1%.
We've done a remeasurement for you, which is what?
4,000.
It's a loss. It's a remeasurement loss. So at the end of the day, you will now have to find the closing balance since you now have all these things. Are you getting it? So when you now have the closing balance, then you know where to treat where each and every figure is going. This is question 10. So you just, once you finish solving it on your own, you can now go and refer, oh, did I get it right in the solution? Where is it?
4,400, yeah.
Yes, this is the remeasurement loss.
4,400.
4,000. 4,000.
When you practice more,
Oh yeah, when you practice more, you get it. That is the key. Once you practice more, you get it. Once you practice more, you get it. So that is what you have. That is what you have. All right. I think there is an error here. You need to check.
Yeah. 14,400. My banco.
So the net
correct.
obligation or asset
is correct.
The net obligation is 18. It's correct.
It's correct. Yeah, I just showed you the bracket for the loss. You said the net obligation of asset. Somebody was asking something.
No, I said the net obligation of asset is 18,400.
Yeah, when you add, it's 18,400, right?
Yeah.
I think they did it. Something is not here. Something is not here in the distance. So it's a loss.
The 4,000.
Yes. Please, let me do it again. Unfortunately, I cleaned it. It was 4,000, right?
You
did the interest for 400, right?
Yes.
And the past and the this is the past and the
6,000.
current, which is 12,000, right? And the loss, remeasurement loss was what? 4,000. So when you do it, how much are you getting? I hope you've not omitted anything.
12,400.
Oh, I think I made a mistake. This one is 14. It's not 12. 8 plus 6, you're saying 14.
14, yeah.
Yes, so this one is supposed to be 14. I added it up. So the 400 is there. So now, what is the final answer? You have this one, you have 18,000. What? 18,000. This plus this is 18,400. Is that not it?
400.
Then when you take off this one, you have 14,400. Is that not it?
Yeah.
Yes. So that is what you have. That is what you have. So see, this is the ICA presentation of the solution. But normally me, if I'm solving the problem, this is not how I would do it. I won't do it like this. This one can confuse you because this thing is actually a loss. It's supposed to be a loss, but they didn't bring the opening balance of 4,000, the net. They didn't bring it.
The net obligation, the opening balance.
Yes, they didn't bring it. Are you seeing what I'm talking about?
Yeah.
Yes, so that is the risk when you learn solutions in past questions, to think you understand it. But at the end of the day, don't you see the 14,000, 14,000? Don't you see it? And let me see how they presented it. I just copied it and I pasted it for you. You see, why is it that here they put it in the bracket here? So later, I may have to solve the thing as I have taught it for students. But you see, I've encountered serious things in class before. A student will go and look at this and say, but said, this is what the ICA people say. Why are you saying this? So please, this is the correct presentation. So over here, what you need to go to your profit, your P&L will be the past service cost, which is 6,000, the net interest, which is 400, and this one, which is 6,000. November is saying 14,400.
Yeah.
Yeah. So let me see what it. Yeah, it's the same thing. 40, and because it's the reason why it's negative here is because it is an expense. Okay. The thing is a P&L expense. Don't forget that. And this one is a loss. All right. So I don't think it is that difficult. And that is why I've gathered all the past questions surrounding it and additional questions for you for practice. God will bless you. Oh, yes, now. So let's look at another past question. Then I'm closing you. Don't worry. Where is any other past question? So all these things are solutions. Okay, this past question. Look at this. May 2020. May 2020 is the same thing. Is the man blah blah blah. You read all these things, and all these things, you realize that it doesn't make any sense. You move
confusing
on.
us.
You move on. Then they said interest income for plant assets. This one, it makes sense for you for something, right?
Yeah.
Employer contribution to the plan, it will make a sense for you. Current service cost will make a sense for you. Interest on plan liability. So this is the interest on the plan asset. This is the interest on the plan liability. Then they've given you the closing balances. And I think there is a figure here we need to read. They said that the accountant was not sure which accounting standard to apply when accounting for the pension scheme. The only adjustment made to the account for the scheme was to expense the. Oh, so that is the only thing they did. They expensed the contribution, but they expensed the contribution for 2018 financial year statement of profit or loss, comprehensive income, and to credit the cash. Please, do you expense the contribution? Do you expense the contribution? Employer contribution to the plan, do you expense it?
No, please.
So it means they made a mistake. See, if you really understand what you are doing, no matter how they phrase the question, you know what to do. Yesterday, when I was ending the class, I showed you the summary of the class, the summary of this whole thing. If you go back and you watch the video, you should be able to get it. All you need is 5 basic things. These are 5 things you are doing. In the SOFP, we are looking at the plan asset offsetting the plan liability to give you a net. But you have to check for asset ceiling. That is all you need in the SOFP. In the P&L, what do you need? You need the net interest and the what? The service cost. Is that not what we said?
Yes.
Then in the OCI, we just need the remeasurement component. Now, if they tell you that they have expensed the contribution, it's a problem. I mean, right there, you know it's a problem. See, the way I take time to teach it, if you guys were with me face to face, it won't be like that. Once I exhibit it and we give 1 or 2 examples, the rest, it's on you. So I even asked some of them to join this class. I don't know if they did. All right. So the interest income. So this one, we start with the net obligation brought down. And of course, you don't see any brought down, so it will be 0. All right. That one will be 0. If you don't see 0, then you have the net interest. So you will do, this is the net interest. This one is 16,500 as against what? 18,000. So the net interest is the obligation net interest. So it will be 1,005. Yes, 1,005. So that is that. you leave, then you have interest, cost, service cost component. That one is 600,000. So you've dealt with this figure. Then contribution. Contribution is 550,000. So you've dealt with this, you've dealt with this, dealt with this, you dealt with this. Then they gave you the closing, the net. So you do 620 minus 58, which is how much? 40,000. And it's an obligation exceeding this, so it will be positive here. Then you now add to find your remeasurement component. So I think this, the difference between this one is 50. And you have 1,005. So you have 50,000 plus 1,005. Then when you take it off the 40,000, your remeasurement component will be like 11,500, like this. That's all, you are done. I don't think it's that difficult. You are done. So once you finish this, this is for 6 months. So you recommend that they will have to reverse this transaction. See, because they said they debited the expense and they credited this. So you have to reverse the transaction. Then these are the correct ones that you actually do. So this one will go to SOFP. This side will go to SOFP. P&L will be the net interest that you have calculated. Then OCI will be remeasurement component. Let me see their answer. You see, immediately I finish this, I just put it on your page. So let me see how the ICA people did. It was question 11, right? Oh, okay, so this is it. Oh, is that it? Yeah, that is it. So opening balance is 0. They brought the return on the assets. They did this, and they had, and they went to do pension obligation too. Imagine, look at this. So when we have 11,500, they have broken down into 2. 13 is here, then 2 is here. When you subtract, you now come and get, you see the long thing they are doing.
To confuse us.
You see the reversal, this journal, the 1,005. Yes, this is the correct expense that has to be passed, the 1,005. All right, this is the interest. The interest, that is so that is the interest, the net, the 1,005, that will go to the P&L. Me, if I were you, they didn't ask for journal, I would just say it will go to the P&L. That's all. Because if you write it like this, you see the pension is 1,005, then it means that there will be another pension liability that will be 13,000 somewhere in their journals. You see, this is what they came to show here. Is it not the same 11,500? That is what they do. So don't kill yourself. Do what you have been taught. This is the you see, instead of reversing the, do you know what they've done? This is the 600. The 6,000. This one. Look, we all know that this one is what was it? That one was it contribution? The 6,000 in the question was, I think it was a service cost component.
No, it was 600,000 though, not 6,000.
Yeah, 600,000. But what was the item? Was it service cost component?
Was service cost component.
Then it means it will go to P&L. It will go to P&L if it was, yeah, so it was a current cost component. So that is that. So all these things they are doing just to hunya you. Just let it go. Do what you know and show what is going to work. That's all. That's all.
No problem.
And the 550 that they only recorded, it was a mistake. So you have to reverse it. That's all. That is all you do. And I want to end here. All the other past questions are there. Take your time, go through. If you are solving and you get any difficulty, kindly let me know. All right. So please, before I end, tomorrow, what time are we meeting, please? And I can cancel and on connection.
5 o'clock. Dawn.
So I remember you said yeah, it's 6 o'clock or
Tomorrow is holiday, and somebody sorry how much. Hey.
and it's 6 if it's possible.